So to start with the land acknowledgement, Toronto is in the Dish with One Spoon territory. The Dish with One Spoon is a treaty between the Anishinaabe, Mississaugas, and Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect.
Amazing. So who am I? As I said, my name is Adam, and I actually am a Ryerson alum. I graduated from Ted Rogers School of Management in 2020 in hospitality and tourism, but had my focus in sales and marketing. So currently working at Questrade, I'm their new accounts associate working out of their Questrade Learning Center, which is a department of their sales team. Main responsibilities include onboarding and educating clients, understanding account types, providing suggestions based on their needs, goals, and objectives, ensuring that clients are aware of the various account requirements in terms of unlocking pension accounts, converting account types, different documents. You and I may open a TFSA and have it be fairly straightforward, but the older you get, the more extensive the kind of requirements there are for unlocking pensions, converting an RRSP to a retirement income fund, so making sure that all their documents are on file and things are done in a timely manner before deadlines. On top of that, being educated and provide information on different types of securities from mutual funds, stocks, ETFs, options, fixed income, various types of trades, whether long or short, and the requirements and costs associated with it. So a little bit about Questrade. Basically, our mission statement is we care about Canadians' financial success. We offer better, simple, more affordable ways to take control of your money. Ultimately, we want to make Canadians more financially successful. Questrade was established in 1999 by our current president and CEO, Edward Kolodenko. We have over 200,000 accounts opened annually and $25 billion in assets under management. We are a 9-time winner award of Canada's best managed companies. So at Questrade, we offer 2 services mainly. So we have managed through Quest Wealth Portfolio. This is where your funds are invested in ETFs that fit your risk level and portfolio type. We have low annual management fees depending on whether your assets are above 100,000, below 100,000. Your portfolio manager will perform real-time rebalancing to make sure that your assets are on target with the allocation, whether they be in US income, Canadian income, fixed, or even international too. And compared to mutual funds, these ETFs have significantly lower MERs. So your average mutual fund will have about a 2.17% MER, whereas the ETFs that we opt for are about 0.13, so significantly lower. The more common service we offer, which I'm sure more of you are interested in, is the self-directed trading. One of the major benefits that sort of separates us is that there's no opening or closing fees. We have lower commissions compared to some of these larger institutions. ETFs are free to buy, and this is something that usually piques people's interest because who doesn't love free ETFs? And there's no annual fees for RRSP or TFSAs like you will get with a lot of these major brokerages. Self-directed investing, we offer a wide range of securities. So something that whatever you're feeling you want, we will probably have. So we offer stocks, options, ETFs, Forex, contracts for difference, mutual funds, bonds, GICs, international equity, IPOs, and precious metals. So a lot of good choices for you to choose from, and more in terms of account types, we have an extensive list as well. However, some of the more common ones for a Quest Wealth Portfolio, which is our managed account, would be a TFSA, an RRSP, a cash account, or even a corporate cash. We do have many corporate clients who are too busy and don't have enough time on their hands and are looking to have a professional handle their accounts for them and passively invest. In terms of self-directed account types, again, same as the Quest Wealth, TFSA, RRSP, margin, corporate margin, investment club. Investment club is actually quite a unique account type. Essentially what it is you can get together with a group of your friends, family members, whatever they may be, and you can actually pool your money as a corporation technically, and use those funds to invest. So if I have a few $1,000s, one of you has a few $1,000s, someone else, you can combine your money, and it just allows you to have more buying power. So you can ideally have a larger difference in your investments. So something we get quite often is ETFs, mutual funds. Are they similar? Are they different? Why one versus the other? So although there's no really right or wrong choice, there is a slight difference and also some similarities between the two. So an ETF, exchange traded fund, is a basket of securities that do trade on an exchange, just like a stock does. Because they trade on the exchange, they're more liquid and they do fluctuate in price all day as they are bought and sold. This is different from ETFs that can contain all types of investments, including stocks, commodities, or bonds. Some offer US holdings only, while others are international. One of the major benefits that I previously mentioned of ETFs is that they have low expense ratios, MERs, and little broker commissions rather than what stocks do. As I mentioned, ETFs are free to buy with Questrade. So this is something that usually entices people and makes them choose ETFs over mutual funds. On the other side of it, you have mutual funds, which is very similar. It's an investment vehicle consisting of stocks, bonds, or even other securities as well. They give you access to diversified, professionally managed portfolios at a low price. This is sort of the main difference, is mutual funds tend to be more actively managed. ETFs are a little more passive. They are divided into several different categories, and ranging from low risk all the way to high risk, and can be geared towards your investment objectives if you're looking for something short-term or long-term. Mutual funds can charge annual fees usually, and these are called the management expense ratios, and also trailer fees. So MERs will be charged by both ETFs and mutual funds, but mutual funds will be significantly higher. So if you do have an advisor purchasing these for you, either with a bank or another brokerage, likely they will be charging you around 2 to 2.2%, plus a trailer fee of 1 or 2%. Essentially, the trailer fee is a commission going to the advisor who facilitated the transaction. Most institutions who have retirement sponsored plans do opt for mutual funds. That is sort of something that I think this generation is steering away from because of the lower fees associated with ETFs, but most employers do still opt for mutual funds. The downside to mutual funds is that they only trade once a day once the market closes. So if you're going to make your trade, the price is going to be determined once the market closes rather than ETFs, where you can actually see the price on the market. So to break it down, why through Quest Portfolio do we only do ETFs? So the main reason for that comes down to the MERs, the management expense ratio. So as an example, with a mutual fund, if you have a $10,000 investment, factoring in 3.17% in fees, 2.17 in MER plus 1% trailer fees, it's about $317 you'll be paying every year in fees. With an ETF that we offer, you're looking at 0.37% in fees, equaling $37 in fees a year. So you can see quite the difference there. And although it may not sound like a significant amount, over time, year over year, and as your investment grows, these will definitely add up, and you'll be wishing that you weren't paying so much in fees. This allows you to reinvest in your portfolio rather than paying someone to, for lack of a better term, push a few buttons to make a trade when you could easily do that yourself or do it at a lower cost. So just as a visualization, you can see a little chart here that is actually available on our website. Assuming you had a $10,000 deposit using an aggressive portfolio over 30 years, you can see how the Quest Wealth portfolio would hypothetically perform compared to mutual funds. And this calculation is, of course, a hypothetical representation of future values, factoring in the fees associated with each type of trade and the difference that these fees actually make. So for our self-directed investing, there's three ways to trade with us. You have Questrade trading, which is our web browser version. Different functions available in it. You have news, you can stay up to date about what's happening. You have real-time data and snap quote, so you can actually receive the live quote for your stock, your ETF that you're trading, and create watch lists and receive alerts so that if there's activity, if price change or anything like that, you can get notified either through your desktop or through your phone. Second one, which is actually something we've just launched, is Quest Mobile. This is a simplified trading platform where you can see your account balances and growth through a line graph, and really easy to read charts and descriptions. Get real-time info as well, and alerts for this as well. Through this app, you can only trade stocks and ETFs because it is more of an on-the-go app right now. So we'd like to keep it simple and smooth running. Third one, which is probably the most popular one, and personally, the one that I like using the most, is Questrade Edge. So this is actually an advanced trading platform that we've built in-house, downloadable for your desktop. It allows you to look at different indicators, oscillators. You have news and market research. You can see earnings reports. There's a stock screener in there, and the whole platform can be customized to fit your trading needs. If you want multiple windows open, you want to pop out those screens for your multiple monitors, and you can do that. It's such an excellent platform, and on top of that, there's even a demo account as well that if anyone's interested in, I can send that to you afterwards, and you can get familiar with the advanced trading techniques that the program offers. So one of the main things that comes up that sort of separates us from the others is our pricing. So our pricing is quite competitive when you compare it to these larger institutions. TD, RBC, stocks are 1 cent per share at a minimum of $4.95 to a maximum of $9.95. Generally, depending on the type of trader or investor that you are, most people are at the $4.95 mark. Essentially, what that means is if you're trading below 495 shares per trade, you're going to be paying $4.95. Compare that to a bank that you invest with, whether you're paying $9.95. Saving $5 per trade definitely adds up. Even if you're doing one trade a day, you're saving $25 a week, $100 a month. So you can see how that would be significant over time. As I said, ETFs are free to buy, and then to sell, they have the same commission structure as stocks. Mutual funds, $9.95 per trade. Options for buying and selling are $9.95 per ticket plus $1 per contract. So something unique that Questrade offers are partner apps. So there's different softwares and companies that we've band together with to be able to provide our clients with unique tools that can help them succeed and expand their knowledge in trading. These 6 are the more common ones, starting with Feather Finance. So as you can see, it's a professional grade portfolio management tool. It helps you analyze your returns, break down your profit and loss so you can understand exactly how you're doing with your trades and investing. MedVeg Trader is a unique one that allows you to see hundreds of indicators, charting software, alerts, scanners, options chains, which is something that's really unique, and even do a risk analysis. Passive, probably my favorite one for the simplified and user-friendly aspect to it. It allows you to manage your portfolio in the sense that it rebalances for you. So hypothetically, if you have a collection of 20 stocks and you want to allocate 3% to XYZ, 10% to ABC, and so on, as these positions move up and down in value, passive will calculate what your allocated an ideal target is versus what it actually is, and it'll allow you to, through one click, rebalance it automatically. It connects directly to Questrade so that you can make sure that your asset targets are in line with what you're looking for. Profitly, that's a cool one as well. Essentially, it is a social trading platform, so you can interact with other traders and investors, learn techniques, strategies, and chat with other people and see what works for them, maybe adopt it yourself, or maybe you have an excellent strategy you want to share with someone that's been helping you. Wealthica is an unbiased, consolidated dashboard of your investments. It shows you exactly what you're looking at in a simplified way. It omits all the complicated graphs and charts and just sort of tells it to you as it is. Trader is a stock selection platform. So you research, buy, and sell stocks all in one place. And again, all of these connect with your Questrade account for simplified use. So because passive is my favorite one that we have here, I thought I would just touch upon that. So as you can see here on the left, this is sort of what it's saying to recommend in terms of trades. It's saying you need to sell this and buy these to ensure that your portfolio on the right side is meeting its target. And so looking at the right side here, it'll tell you in the blue what your target is and how much you've allocated to each one and what the actual allocation is. So by clicking preview orders in that bottom left corner, it'll execute the trades for you, and you'll see that your accuracy will go up and that your allocations will be on target. This can and will help you, position jumps in value, decreases in value, to making sure that you're getting the most out of your portfolio. So options trading. Here, this is something that everyone is getting into. Maybe a few of you know about it. Maybe you'd like to know a little more, but today's your day because we are going to talk about options trading. So what are options? So an option is a contract giving the buyer the right, but not the obligation, to buy or sell the underlying asset at a specific price on or before a certain date, also known as the expiration date. Each option contract represents 100 shares of the underlying security, and the buyer pays a premium for each contract. To break that down, if an option has a premium of 50 cents per contract, buying one option will cost $50 at 50 cents times 100 shares per contract, $50. The premium is based on the strike price or the price for buying or selling the security until the expiration date. There are a lot of other factors that go into the cost of the premium, but a lot of the time it is determined through an algorithm in the options chain. So some general definitions to keep in mind for the next little bit. Expiration date is the day in which an option contract expires and ceases to exist. All trading for that specific contract needs to happen before that. Strike price is a fixed price at which the owner of the option can buy or sell the underlying security. Premium, as we mentioned, is the price paid or received in some situations for an option in the marketplace. Equity option premiums are quoted on a price per share basis. So the total premium amount paid by the buyer to the seller is equal to the quoted amount times 100, since there are 100 shares in each contract. In the money essentially means that your strike price that you have purchased, an equity call contract, is in the money when the strike price is less than the current underlying stock price. An equity put contract is in the money when the strike price is greater than the current underlying stock price. So we'll go over calls and puts later to give you some more context and example as to how they work, but just try to remember these terms as they will come into to play later on, but I will break it down for you during the examples as well. And out of the money is the opposite of in the money. It's an equity call option that's out of the money when the strike price is greater than the current underlying stock price. An equity put option is out of the money when the strike price is less than the current underlying stock price. Implied volatility is an estimate of an underlying stock's future volatility as predicted or implied by an option's current market price. Essentially, The implied volatility is how much the premium can potentially move up in value. To exercise is to employ your right on an equity contract to buy or sell 100 shares of the underlying security at the strike price per share at any time before the contract expires. And so, as we mentioned, each contract has 100 shares. If you were to exercise your right to buy a call option, essentially you would be purchasing 100 shares of the underlying stock. So this is something I thought I would include just because it's extremely useful to know when you are going to be trading options. There's a lot of information on the screen. So understanding where to look and what the information represents will really be helpful in understanding options trading. So first one that we touched upon is the expiration date. So as you can see, the expiration for this specific options chain is the 3rd of December, 2021. The underlying asset price, as you can see, is 161.25. That is the current trading price of the asset in which you're buying the option contract for. The contract premium, as you can see here, is $9.60. That's the price of the premium you're going to pay. But as we said, each contract represents 100 shares. So you would multiply that $9.60 by 100. The reason it would be so expensive is because typically the higher the premium, more likely you're going to make money off of it. That's sort of just a generalization there. Implied volatility, again, how much the value can move up by. And then the strike price is the price in which you are trying to secure your option contract, whether it be a call to purchase those shares or a put to sell those shares. So something else to notice here is on the left side, these are all of your calls. So these are you wanting to buy an option contract, hoping that the price of the stock will go up. Puts on the right-hand side, you're essentially speculating that the price of the stock will go down. So the blue represents in the money, the black represents out of the money. So you can see how they're opposite. So with calls, all of these are in the money because the strike prices in the middle are lower than what the underlying asset is. So these calls are all in the money, meaning that the strike price is higher. On the right side, you have the puts. So as you can see, the opposite amount of values are in the money, because with a put, you're going to want to have the strike price be higher than what the underlying asset is. And so something to keep in mind, that when you are trading options, there's something that is factored in that will help you determine how an option contract may move. And these are what's known as the Greeks. So there are a set of risk measures named after the Greek letters that denote them, which indicate how sensitive an option is to time value decay, changes in implied volatility, and movements in the price of its underlying security. So the four main Greeks are delta, theta, gamma, and vega. So delta, it represents the change between the option's price and a $1 change in the underlying asset's price. Delta of a call option has a range between 0 and 1, while the delta of a put option has a range between 0 and -1. As an example, assume an investor is long on a call option with a delta of 0.5. Therefore, if the underlying stock increases by $1, the option's price would theoretically increase by 50 cents. Theta. Theta represents the change between the option price and time, also known as time decay. Essentially, this indicates the amount an option's price would decrease the closer you get to the expiration date. So an example, assume an investor is long on an option with a theta of -0.5. The option price would decrease by 50 cents every day that passes. The 3 trading days passes, the value would theoretically decrease by $1.50. This is assuming that all other information is constant and we're just focusing on data, but things usually change together and all of the Greeks have an effect on the option contract. Gamma. So gamma represents the rate of change between an options delta, which we said was the rate of change between the options price and a $1 change in the underlying assets price. So gamma indicates the amount delta would change given a $1 move in the underlying security. So let's assume an investor is long on a call option for Apple. The call option has a delta of 0.5 and a gamma 0.1. Therefore, if Apple increases or decreases by $1, call options delta would increase or decrease by 0.1. Vega, last one here. So this represents the rate of change between an option's value and the underlying asset's implied volatility. As we discussed, implied volatility is how a premium can move up and down in value. So this is the option sensitivity to volatility. Vega indicates the amount an option price changes given a 1% change in implied volatility. For example, an option with a Vega 0.1 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 1%. So that was the basics here. We're going to be talking about long calls and puts now. So in options trading, there's 4 different levels. First one being long calls and puts, second being covered calls and puts, third one being spreads, and fourth one being uncovered calls and puts, sometimes referred to as nakeds. For the sake of this presentation, we'll be doing level 1 and then talking about covered calls as well. So as you may recall, there are 2 types of options. So there's call options and put options. So to recap, a call option gives the owner the right, not the obligation, to buy a specified amount of an underlying security at a specific price within a specified time. The specified price is known as the strike price, and the specified time which a sale is made in is the expiration. You pay a fee to purchase a call option, also known as the premium. And as we said, this is a per share charge and is actually the maximum amount that you can lose on a call option. You can only lose what you pay in your premium for a call option. For a put option, gives the holders of the option the right, but not the obligation to sell a specified amount of underlying security at a specified price within a specified time frame. Put option prices are impacted by changes in the price of the underlying asset, the strike price, time decay, interest rates, volatility, and they increase in value as the underlying asset falls in price, as volatility of the underlying asset price of the asset price increases, and as interest rates decline. So if an underlying asset, a stock goes down in price, your put option goes up in value. With a call, if the stock price goes down, your call option goes down as well. The value goes down as well. It goes up when it increases in value. Put options' value as the underlying asset increases in price. And the closer you get to the time of expiration as we deal with time decay. So here's an example to understand a little bit more. A single call option contract may give the holder the right to buy 100 shares of XYZ stock at the strike price up until the expiration date. There are many expiration dates and strike prices for traders to choose from. As the value of XYZ stock goes up, the price of the option contract goes up, vice versa. The call option buyer may hold the contract until the expiration date, at which point they can exercise their right and secure 100 shares of that stock at the strike price, or before the expiration, they can sell their option contract on the marketplace for the premium, which is increased in value, or it's decreased. So as an example, let's say someone buys one contract of XYZ trading at $135 with a strike price of $150 and an expiration date of January 21st, 2022, and a premium of $3. On January 13th, 2022, that stock trades at $165 and the premium has increased in value to $4.50. This contract is now in the money, meaning that the stock price is trading higher than the strike price. So the holder has two options. They can sell at market for $4.50, current premium value. They would profit $1.50 per contract, which comes out to $150 as there's 100 shares per contract. Or they could exercise their right to buy the underlying asset in shares, 100 shares per contract at the strike price. So exercising your right to purchase these shares would cost $15,000 at $150 per share times 100 shares. Put example now. So assume an investor buys one put option for XYZ, which is currently trading at $445 with a strike price of $425, expiring in 1 month. For this option, they paid a premium of $2.80 or $280. If the units of XYZ fall to 415 prior to expiration, the $425 put will be in the money and will trade at a minimum of $10, which is the intrinsic value because of the 425 minus the $415 that it falls to. The exact price for the put would depend on a number of factors, most important of which is the time remaining to expiration. So assume that the 425 put is trading at $10.50. Since the put is now in the money, the investor has to decide whether to do A, exercise the option, which would give them the right to sell 100 shares of XYZ at the strike price of 425, or sell the put option on the marketplace and pocket the profit. So with selling a put, it's a little different because if you purchase a put contract and you exercise your right, technically you are selling those shares. But if you don't actually own the underlying, if you don't own 100 of the underlying shares, that would technically be a short sell. So you would either stay short, or you could buy back those shares again to cover your short. So there's a couple of factors there when it comes to puts. They're a little trickier than option calls. So this is essentially how you profit. So on the left side, we have calls. So as you reach the strike price, that's when you start to make money from it. From a put, as the strike price, as the underlying moves down, your profit goes up. So they're reversed. So about covered calls now. A covered call refers to a transaction in which an investor selling call options owns an equivalent amount, 100 shares per contract of the underlying security. To execute this, an investor holds a long position in an asset, then writes or sells that call option on that same asset to generate an income stream. The investor's long position in the asset is the cover because it means the seller can deliver those shares if the buyer on the other end chooses to exercise. So covered call example. So let's say an investor owns shares of XYZ. Although the investor likes its long-term prospects and the share price, they feel the stock will trade relatively flat in the shorter term, perhaps within a couple of dollars of its current price of 25. If they write a call option on XYZ with a strike price of 27, they earn the premium from the option sale. For the duration of that option, though, they cap their upside on the stock to 27. So assume the premium they receive for writing a 3-month call is 75 cents. One of two scenarios will play out. The shares will trade below the $27 strike price, and the option will expire worthless, and the investor gets to keep the premium from the option. They still own that stock, but have an extra $25 in their pocket, less brokerage fees. If the stock price goes above 27, the option is exercised by the buyer, and the upside in the stock is capped at 27, meaning that is the most that they can profit from it. If the price goes above 27.75, which is the strike price plus the premium, the investor would have been better off holding the stock because they would have made more money from it if it increased in value. So this is how a covered call makes profit. So essentially, you continue making profit up until the strike price at expiration. So if the stock price keeps going up, you sort of cap your profit at that strike price, because that's essentially what you'll be having to sell those shares for if someone exercises their right. So many people often wonder why stocks, why options, how are they similar, how are they different? So this example should help break it down and mathematically visualize the potential in each trade. So if a trader wants to invest $5,000 in XYZ at $165 per share, they can purchase 30 shares for $4,950. Suppose then that the price of the stock increases 10% to $181.50 over the next month. Assuming there's zero brokerage fees or transaction fees, the portfolio will rise to $5,445 in value, leaving the trader with a return of 10% or $495. For an options trade, let's assume that a call option on the stock with a strike price of 165 that expires a month from now and has a premium of $5.50 per contract. Given the budget, they can buy 9 contracts for a cost of $4,950. Because the option contract holds 100 shares, they're essentially trading 900 shares of that company since they have 9 contracts. The stock price increases 10% at expiration. The option will expire in the money and be worth $16.50 per share, or $14,850 on 900 shares. So you can see that that's a return of 200% or $9,990 on the amount invested. So it's a much larger return compared to trading the underlying asset. Okay, that is my presentation on options and on Questrade, and I wanted to open up for questions. If anyone had anything they'd like to know, clarification, I know it can be a lot to take in and understand, but I'm here to answer any questions anyone might have.
I'd like to start. First off, thank you so much, Adam. And if anyone has any questions, feel free to unmute yourself and ask, or you can write in the chat box. So for options, you said that if it goes out of the strike price and you lose just your premium, would you say that they're less risky then because you're only losing your premium, but there's a whole upside?
So options are definitely risky to trade. I mean, with anything that has potential for a high return, there's also potential for loss. Something to keep in mind is if you are trading an option contract, the most that you've put in for a premium, let's call it $200, that's the absolute most that you can lose because that's all you've put in. If you go into a stock and spend money, whatever it is, investing, let's say 100 shares, that stock could plummet and you potentially have more to lose in that sense.
Mm-hmm. Thank you.
Of course. Any other questions about options, Questrade in general?
I have a quick one here, just about just Questrade in general, going back a little bit. First off, thanks for your presentation, Adam. It was great. I think we all really learned a lot, not only about Questrade, but about options. Just wanted to pedal back to the Quest Wealth portfolio a little. So I have a Questrade account now. And one of the things that I think a lot of us struggle with as university students is actually just finding the time to trade, even though, we are in a trading club, obviously. It's something that I think we all have in common that we like to do. And I think we try to do as much as we can. But I think the Quest Wealth portfolio is kind of a nice medium for some of that kind of money that you can just put aside into passive investments. That's more or less the idea of it, correct?
Yeah, so that's exactly right. So, the major benefit behind Quest Wealth is, as you said, you may not have a lot of time on your hands. You may not know where to invest, who may not feel comfortable yet. So the benefit is that it's sort of peace of mind and passive investing. So letting someone else take the reins and invest for you based on your risk level. So when you do open up an account, you'll provide some information, complete a questionnaire, and that'll be used to assess a portfolio for you, ranging from conservative, where you're focusing on minimizing loss and maintaining capital, all the way to aggressive, where you're taking on more risk, accepting higher account fluctuations, and having a professional portfolio manager invest for you. And on top of that, they are actively managing that account. So they're rebalancing. Anytime deposits come in, they'll invest it. So it's peace of mind in that sense if you have a busy schedule but still want to invest. And of course, at a significantly lower cost than you would get with other institutions.
For sure.
And we have a question in the chat box. Oh, sorry, Leo.
Yes, just one quick follow-up from that, just before we switch subjects here. But so you do the questionnaire. How much variety is in there? So let's say I go on and I do the questionnaire. I'm assuming I'm going to have a pretty aggressive. I mean, generally, especially since we have such long time horizons at our age, generally we would be more on the aggressive side of investments. And you might not have the answer to this, and I completely understand if you don't. But let's say I test pretty aggressively. Like, what would it look like when I actually get invested? Is it a fund-to-fund solutions? Is there like an aggressive fund that I'm placed in, or is it a weighting between, let's say, 5 different funds that is constantly being balanced?
So each portfolio does have a specific asset allocation. It could be between U.S. equity, Canadian equity, international, and fixed. Typically, the lower the aggression of the portfolio, you're going to have more fixed income because you're working on maintaining your capital. The ETFs that are invested, will depend on what's held inside. So if you're having a more aggressive portfolio, the stocks themselves under that ETF or the funds, whatever they may be more volatile. So they may move up a little more and quicker than some of the others, which result in the account fluctuations. So hypothetically, one day you could see your portfolio up 3%. 2 weeks from now, you could see it back up to 8. 3 weeks later, it could be back down to 4. So the idea, it's more volatile. You're accepting more risk in the hopes that in the long run, things go up over time, and you're taking on more risk to get a higher return because of the volatility. Does that answer your question?
Yeah, perfect. Thanks.
Okay.
So we in the chat.
Sorry, one last thing.
Yes.
So there's no obligation at all with Quest Wealth Portfolio. So, if you're ever curious, you can log into your account, open a Quest Wealth, submit the application, and see what they're asking, see the different portfolios that they're offering you, and you could even take a look. It will show you the ETFs that will be invested, and you could Google them and see what's being held and get a better idea as to where your money is actually being invested in. If you're happy, move forward. If not, you discard your application and keep a self-directed one. There's absolutely no obligation to keep it open.
Okay, great. Yeah, thanks.
Yeah. Sorry, so there were some questions in the chat.
Yes. So Teresa asks, can we reach out to you for more information? And she also followed up with, would passive be a better tool for beginners?
So one, yes, you can definitely reach out to me. Before we finish, do you have like a group chat or anything? Like you have my email address, you can post it in like a group chat or send an email to the group.
Absolutely. Yeah, I'll post it in the chat below.
Yeah, and definitely let me go right now. Okay, so that's my I post it to Sabrina only. All right, so there's my email in the chat. So yeah, anyone who has questions, wants more info, definitely reach out to me, send me an email. Happy to go over anything. If you want to chat, let me know a good time to reach you, and I can certainly give you a call and talk about whatever you'd like. In regards to passive, I wouldn't say that it's better for beginners. I mean, it's an excellent tool even for experienced traders. It just allows you to simplify your portfolio rebalancing. So Typically when you're going to build a portfolio, you're going to say, all right, I want to allocate this much to this company, this much to that company. And as it moves up or down in price, it can be difficult to manually execute those trades through your brokerage to, adjust so that you're on target. You don't want to be like, all right, I'm going to send an order for this to make it this. All right, now I got to sell this stock to bring it back up. And it's a huge hassle. I've tried it, not worth it. It's a huge pain. So passive takes care of all of that. And just with the click of a button, it'll make sure that your desired portfolio is on target. And as a beginner, it's definitely good. I wouldn't say it's just for beginners, but if you're really starting to manage a portfolio, definitely give it a try and see how much easier it makes your life in managing that portfolio. And as I mentioned, it is free for Questrade clients. It's typically $100 a year, but as a Questrade client, you do get that for free.
Thank you. Next question we have is, how is someone's TFSA linked to Questrade, and in regards to the government knowing your contribution room and how that grows year on year?
Yeah, so as a Canadian brokerage, we are regulated, the same way that the banks would be through IROC, which is the Investment Industry Regulatory Organization of Canada. We're a member of CIPF, which is the Canadian Investment Protection Fund, so that your assets are insured. Similar to the banks, your TFSA is connected to the CRA, so we report all activity to them, so that your contributions are counted and withdrawals as well. And there's no limit to how many TFSAs you can have. You could have one with Questrade, one with your bank, one with something. You'll get a 10 with Questrade if you wanted, and your contribution just applies to all of them. Yeah, it'll be linked to the CRA, so any activity you have will get reported to them.
Awesome.
Does that answer the question?
Please let me know if that answered your question or not. I thought it was clear up.
Okay.
Another question we have is, you mentioned something about a demo in one of the apps. I was just wondering if you could provide more info on that.
Yeah, so the demo I was referring to is our trading platform, IQ Edge, now called Questrade Edge Desktop. So that's the practice version of our customizable trading platforms. That's where you can practice trading to if you want to learning different oscillators, indicators, you want to see the research functions, you want to practice day trading, whatever it is. This platform gives you $1 million to start with, 500,000 US, 500,000 Canadian, and essentially just play with it as you'd like to familiarize yourself with how trading works, how the market works. Maybe you want to practice understanding, RSI or your MACD or whatever. It's a great way to do it. And if anyone's interested, send me an email and I'll be happy to send you a link to that demo account. Even if you're not a Questrade client, I'll still be able to send one to you. Awesome,
thank you. Another question we have from Teresa is, can someone switch from a managed portfolio to a self-managed one? And how would that work, switching from, say, a brokerage that has your mutual funds and whatnot over to Questrade?
Yeah, so just for clarification, when you're saying a managed portfolio, do you mean from a separate institution or from a managed portfolio at Questrade? Because there is sort of a different process. Both.
Teresa, that's your question. I would assume from a separate brokerage.
I see a message here saying both. Yeah. So in terms of from another institution, essentially you would open your account. You'd complete your profile. Once your account is approved, it usually takes a couple of days just to verify the information, and from there, through your client portal, you can submit a transfer request online. It takes a couple of minutes. All you need is your account number, the name of the institution you're transferring from, and the value. And then our transfers team handles that request, and we'll have your accounts brought over. On top of that, we'll even cover your transfer costs up to $150 per account that you transfer to us. So that's sort of how you get an account from another brokerage over to Questrade, self-directed. The only thing to keep in mind with that is, as I mentioned, a lot of managed portfolios with these other banks will invest in mutual funds. If you want to keep those, by all means, there is a selection of mutual funds that we don't carry or offer. So you just want to confirm with us ahead of time. Even myself, if we can have all of your funds transferred over. Otherwise, if it's just stocks, ETFs, those can always be brought over what's called in kind.
So
Yeah.
the follow-up question. But before we get to this follow-up question from Isa, a bit of a funnier question by Liam. You have a very interesting last name.
Yeah.
Is that your real last name?
It's my real last name for as long as I can remember, all 26
cool.
years.
Very cool.
Yeah, thank you. Yeah.
So
It
assuming
sounds good.
we could do in-kind transfers, and can you do that with non-regular accounts as well, or non-registered accounts?
Yeah, definitely. So when you're doing a transfer, the only way you can transfer it between brokers is if they are matching account type. So you would go non-registered to non-registered, TFSA to TFSA, so on. And that's how you can get that transferred. And the good news is when you are transferring, there's no tax implication. It's not considered a withdrawal. It's not considered a deposit. So it's more of a sideways transfer. So it allows you a little more flexibility in that sense.
So even if you have, all your funds and assets and equities that have grown in value and you move them over to Questrade, it's not a sale.
Exactly. They'll be transferred over exactly as is, and including your average cost, everything will remain the same so long as you do an in-kind transfer.
Great. Awesome.
Mm-hmm.
Can we buy penny stocks as well?
Yep. So penny stocks traditionally are referred to as OTC or pink stocks. Those are the exchanges that they trade on. Those can only be traded in a non-registered account. With us is a margin account. So you can definitely trade your penny stocks in a margin account.
Shami, you're welcome to unmute yourself if you have a question.
Yeah, go ahead. Ask away.
Hi, can you hear me?
Yeah.
Okay, awesome. So I don't know if I really truly belong in this group because I feel like everyone has more knowledge than I do. I'm trying to do more investments in Canada. My background is more Indian investments. And so I have 4 questions. I don't know if I should just shoot them one by one or say them all.
Yeah, let's start by one, maybe a bit easier for me to keep track of. And as long as we have time, if everyone's happy, I'm more than happy to go through them.
Okay, so the first question I have is, I obviously I want to work with a qualified investment manager. I don't feel like I can do self-directed yet completely. So I wanted to know how Questrade compares to, institutions like Scotiabank or Edward Jones, or, apps like Wealthsimple. Like, what are the differences, using these versus using Questrade and yourself? Because for me, the person is more important than, the organization or the tool.
Yeah, certainly. That's a great question. So that is something we get quite often. And, without having a deeper understanding as to, how TD, RBC, Edward Jones, how they invest, sometimes you do have a mix of stocks, ETFs, mutual funds from my experience. And, the clients I've helped bring over from these institutions to Questrade, something that they always say is their high fees. So ultimately, what it really comes down to is how your funds are being invested. So with these institutions, as I said, most of the time they will invest in mutual funds because when you have an advisor, there's more for them to gain in that sense. So you'll be paying those trailer fees, which are going straight to their pocket, which could be 1 or 2%. Keep in mind that is a generalization. It's not always the case, but majority of the time is how it works in my experience and from what I've heard from clients coming over to us. What sort of separates us is the fact that you have a team of dedicated professional portfolio managers who are available to speak to you, who have nothing to gain from your investments. Essentially how it works is you pay a management fee, which is 0.25% a year if your assets are below $100,000, and that percentage rate is it's not adjusted, but the amount that they receive changes as your portfolio goes up and down. So if your portfolio doesn't do well, your portfolio managers aren't still taking home the same amount of money. So it's relative to how your portfolio is performing. So that's sort of what separates us, is that low fee and the fact that ultimately our goal is to make you more financially successful. It will also rebalance your portfolio. So this is something that a lot of managers don't do or don't do regularly, whereas with us, it's actively rebalanced. So when an asset grows in value, let's say it goes up 10%, that's sort of out of the threshold of what you would want it to be, because if something goes down in value, you sort of lost those gains. So when an asset reaches a certain point, your portfolio manager will reinvest those gains back into your portfolio and sort of allows you to grow it a little bit faster in that sense.
Okay, thank you so much, Adam. So that definitely helps. So my other question is, does Questrade is it like a one-stop shop of investments? Like, does it cover everything from some of the things you mentioned, like mutual funds, ETFs? Does it also cover crypto? Would it be all in one spot, or would I have to depend on other platforms?
So we do offer a large amount of securities. We'll offer all the account types that you would get elsewhere: TFSA, RRSP, RESP. In terms of securities, you have stocks, ETFs, options, bonds, IPOs, fixed income, and even Forex and CFDs as well. The only thing we don't offer are cryptos. But something you can do to gain exposure to them still is there are various ETFs that allow you to track certain cryptocurrencies or even allow you to invest in them through the ETF. So that is also an option if that's something you are interested in.
Okay, awesome. And my third question is, do you have any kind of customized investment management package, especially for women entrepreneurs?
So we don't have any customized packages. What allows us to be so financially efficient is the fact that we have sort of a streamlined process that we do. So although your portfolio is curated based on the information you provide, we don't actually customize them for you. Based on the portfolio you get, there's a specific amount of ETFs that your portfolio manager will choose from to invest in, but we don't actually curate portfolios. The only one that you could have different is what's called an SRI. It's a socially responsible investment, where the companies in your portfolio focus on green initiatives, have a low carbon footprint, are environmentally friendly. That would be sort of the closest one or closest thing that we could offer.
Okay, that actually is very interesting because I work with social impact ventures, so that would definitely be interested in the SRI option.
Yeah, for sure. And yeah, it's definitely available. And although the portfolio itself may not be an option for what you're looking for, through a self-directed trading account, there's so many tools and resources out there, and it wouldn't be too difficult to determine what it is that you're looking for, and even through the Questrade platforms, researching the different stocks and deciding, okay, I like this stock or this ETF, I see potential in it, and curating your own platform, and even using some of the partner apps that we are affiliated with to curate that yourself. So that could be an option too.
Okay. And I was also curious, I know someone asked about your name. I mean, just by the looks of it, you look of Eastern descent, maybe, I don't know, potentially Indian or from the East, but your name definitely doesn't sound it. So, I mean, do you mind me asking if that's like your Western name, or is that your original, like?
Yeah, so that's also a question I get often. So yeah, my background is Indian. My name is Fancy. It's not like a westernized name. Like as long as I can remember, my parents, my grandparents, aunts, uncles, great grandparents, their last name is has always been Fancy. I mean, somewhere down the road, who knows when, at least 3, 4 generations previously, it was clearly changed. Fancy is not a name for an Indian person. But where and how it got changed, your guess is as good as mine.
Okay, awesome. I hope you
Yeah.
don't mind me asking.
No, not at all. That's fine.
Okay. And
Thank
I
you.
also wanted to ask, can we potentially have you do a session for Social Venture Zone, which is an incubator of Ryerson? Because I think a lot of our ventures could benefit from your session that you did today. Very similar.
Tell you what, did you receive my email in the chat?
Yes, I did. Yep.
Yeah, send me an email with sort of what it is that you're looking for and tentative dates and sort of some context of the program or association, and you and I can chat about that privately.
Okay, perfect. Thank
Yeah,
you.
of course.
Thank you. Gevorg, I see you have your hand raised, and we'll cut this as the last question.
Okay, thank you. Sorry, I'm not sure how much time we have, but I'll try to make it short. First of all, Adam, thank you so much for the presentation. Very informative. Really nice meeting you as well. I think my question is less technical, but since a lot of us are interested in trading and gaining the skill of trading, I would say for the most part during the first 30 minutes or 1 hour, when the volatility is the highest and you can catch huge moves. How would you recommend the students to manage finding time to trade from at least 9:30 to 10 and manage classes? And the second question is, in your opinion, what would be a good resource to get the knowledge to get started with live trading?
Yeah, great question. So the first question in terms of finding time, I mean, you know, throughout the day, you know, it's been proven that volatility is highest during the first hour of trading and then the last hour of the day as well. However, between that, there's lots of opportunities. So you need to find what works for yourself and just identify what time you have. And, you know, if you can't, you know, invest or trade every day, that's fine. You need to do it on a schedule that works for you, and make sure that, you know, you're focused, I guess, in that sense. You're not trying to rush anything, and that you're working at your own pace. That'll be the best way to learn and understand concepts. And to help with that, the best thing I personally think can be done is to use a demo platform. It really helps solidify your knowledge and understanding of you know, how the market works, and you know, how news coming out can affect a stock as well. So there, through the Questrade platform, you know, you have access to all of the features in the real platform too. And you can use this to play around with. You can make ridiculous, excessive amounts of trades. You could put $500,000 on Apple if you wanted and see how it goes, you know, just to get an idea. But the platform itself will be good for you to understand how the market works and using the tools within it to educate yourself on trading. And if you make a mistake, you know, you thought something was going to go up, it goes down. Good news is it's a demo account. You can just reset. But that'll be the best way for you to start learning. And even through videos online or tools or whatever, there's so many resources that can help you, courses that you can take. And depending on what you're looking for, I'm sure there's specifics out there.
Awesome. Adam, thank you so much for coming and educating us on Questrade and on options trading. I think everyone gained a lot out of it. I learned a lot about options. And thank you everyone for coming to our event. We will be having one more event of the semester where we will also announce the winners of our trading competition, which will be happening in about a week. The exact date may change, whether it's a Tuesday or a Thursday, but we will keep you posted in our social media accounts, group chats, newsletters. Thank you everyone for coming out, and have a great night. And thank you, Adam.
Yeah, thanks so much, everyone. It was a pleasure. As I said, my email is here. If you have any questions, let me know. We have lots of resources that I can, point in your direction. If you're wanting to learn more about options trading, send me an email and I'll be happy to send over some material that we have that I know even for myself has been very useful and can help you as well. Cool. Amazing. Thanks so much, everyone, and take care.